Welcome to another episode of Capital Economics, where we're going to continue our presentations on recession indicators. And given our most recent presentation, we focused on the yield curve. And on that presentation, we were looking at the 10-year Treasury note against the 3-month Treasury bill. Today, we are going to look at the yield curve with the 10-year Treasury note against the 2-year Treasury. And there's some back and forth between academics and practitioners on Wall Street as to which one is the better indicator. However, there are multiple yield curves, and we are going to be looking at those as well. But since we have seen an inversion on the 10 and 3 month and on the 10 and 2 year, we thought it was prudent to take the time to actually put together a presentation so we can walk through and do some analysis here together. Now, continuing with what we've been stating in previous presentations is we want to make sure that we're all on the same page, and so we want to give a formal definition as to what a recession actually is, because if you're paying attention to the financial mainstream media, you're usually going to get the technical definition, which is 2 consecutive quarters of negative GDP growth. But it is the National Bureau of Economic Research that actually makes the official determination. And they look at a whole host of other issues beyond GDP. They look at real income, they look at employment, they look at industrial production, and they look at wholesale and retail sales. So it's a more holistic view as to what's actually taking place in the overall economy. And that's where we are going to sort of draw the line and say, the technical is interesting. Yes, that is going to signal something, but we actually are going to pay more attention to when the National Bureau of Economic Research actually makes that call. And as we make our way through multiple presentations, we will also be focusing on GDP, real income, employment figures, industrial production, and wholesale and retail sales as well. So we can sort of gauge and sort of maybe forecast when we are likely to find ourselves here in the United States in a recession. So continuing, let's take a look at some data. Here we have just a simple graph of the 10-year Treasury. We have been in a 30-year plus bull market because obviously bond prices and their yields are inversely related. So when you have higher bond prices, you have lower yields. And as you can see here clearly, we peaked out here at 16% back in the early 1980s and have been down ever since. So we've had a lot of buying in the bond market, pushing yields ever lower, hitting basically near all-time record lows here in 2019, below 2%. And with all anticipation that the Federal Reserve is going to continue putting downward pressure on interest rates, we can anticipate that this is going to continue to the downside, although we do caution in our podcast on the Capital News that it is quite possible and maybe even probable that interest rates will get a mind of their own. As the United States embarks upon $23 trillion with the national debt with trillion-dollar deficits, the market might say, Uncle Sam, you got to give us a little bit more bang for our buck, and 2% just isn't going to cut it, despite the efforts that may very well be undertaken by the Federal Reserve with lower interest rates, which it does appear that they are beginning a new easing cycle, which they have not done since the onset of the Great Recession, and it is quite possible that the Federal Reserve is likely in the near future to continue expanding its balance sheet, which would be called quantitative easing, which, if that's the case, this would be the 4th round of quantitative easing. So that's the 10-year Treasury, just to give you a glimpse as to how that has been trending over the years. And here is another yield curve, and this is the difference here sort of between the 10-year Treasury and the Fed funds rate. This is, of course, the interest rate that the Federal Reserve controls, and this is how they are doing or conducting monetary policy. Now, what we witness here, for those of you who may be unfamiliar with some of these graphs here, what these vertical lines are, they indicate recessions. And clearly the width of these bars, these vertical bars, indicates the severity or the duration of these particular recessions. Now, what we notice here, and obviously the blue line is representative of the 10-year Treasury and the red line is representative of the Fed funds rate. Anytime we see the 10-year Treasury dip below the federal funds rate, we enter recession. That's, going all the way back. But let's just look at the most recent. And the reason why I highlight and want to pay more attention to the most recent recessions is because I believe we find ourselves in a new paradigm where central bankers are playing an ever-increasing role in daily economic affairs. So this was not the case in the 1950s and the 1960s and 70s and even in the 80s, although slowly but surely they have been getting more and more involved in the day-to-day affairs of the financial markets. But this really was a new paradigm under the leadership of Alan Greenspan, a former chairman of the Federal Reserve. And so when you're in the mid-'80s through the 2000s to current day, the Federal Reserve is there. That's why you have financial markets the world over waiting on pins and needles if there is a Federal Open Market Committee meeting, because they want to know what's going to happen with interest rates and what type of forward guidance are they going to lend. So I think we find ourselves in a new paradigm. And if we look back to where we were with the 1990s recession, you again see this 10-year Treasury dip below the Fed funds rate. When you have the dot-com bust and the 2001 recession, you have once again the 10-year Treasury dipping below the federal funds rate. And prior to the onset of the Great Recession in 2008, we once again see the 10-year Treasury note dip below the federal funds rate. And if we continue to today, we now once again find ourselves with the 10-year Treasury yielding less than the federal funds rate. Now, this is monthly data. The Federal Reserve has once again slashed interest rates. So now it's in a range of 1.75% to 2%, with all anticipation that the Federal Reserve at the end of this month, October, will continue to cut interest rates and may even note that they may begin quantitative easing at some point in the future. So we are in the midst of the longest expansion in recorded U.S. history, and now we are seeing a sign that may indicate that it is coming to an end. So again, this is the yield curve between the 10-year Treasury and the federal funds rate. We will do another presentation on this and some others as well in the near future. So here actually is the yield curve between the 10-year Treasury note and the 2-year Treasury bill. And again, we have data going back to the 1970s, and anytime this yield curve inverts, that is to say that it goes negative, that the 2-year note is yielding a higher amount than the 10-year, you get a negative number. This seems to note that we are likely headed for a recession. And that's what this presentation and previous presentations have been all about. Just trying to get a grasp of history. It may not repeat, but it may certainly rhyme. And that's what we're going to see. And if we are near the end of this business expansion in this business cycle, then this yield curve, whether it be the 10 and 2, whether it be the 10-year and 3-month, is once again holding water and gives it credibility. So again, if we just look real quickly here, because that's all it takes for this type of analysis, if you just look quickly before these recessions, you see that the yield curve between the 10-year and the 2-year inverts and goes negative. Now, there is a difference, and we noted this in our previous presentation when we were talking about the 10-year and 3-month. There is a difference, we believe, between a yield curve that is inverted that has time duration, that is to say it is sustainable, or it is non-sustained, so it is just short-lived. Okay, so as you can see here, prior to the 1991 recession, you have the yield curve. This is a sustained yield curve. When you go to the mid-90s, 1998, you see how it just dips below here, goes inverted, but then it comes right back up. That, to me, is a non-sustained, and those are sort of a blip. These are one-offs, if you will. But then it inverted once again prior to the bursting of the dot-com bubble, and then we found ourselves in recession. And you can see, once again, the same thing happened prior to the Great Recession in 2008. Currently, we find ourselves with a yield curve that sort of just went negative only a handful of weeks ago, and this is not a sustained yield curve inversion with respect to the 10-year and 2-year Treasury. However, with respect to the 10-year Treasury and the 3-month, that has been a sustained inversion. And when you have that inversion, which has a significant duration, that too is highly predictive of an ensuing recession. So right here, we find ourselves once again in inversion. Does this mean that we are going to find ourselves here in the United States in a recession within the next year, maybe 2 years, maybe within a handful of months? But we're going to continue our analysis and we're going to see what this is telling us. So continuing again, this is to highlight the difference between the 10-year and 2-year and the 10-year and 3-month. And what I want to highlight here is, as you can see, going back through a few recessions, it has been the 10-year and 2-year which goes negative first. Now, this time around, if we fast forward to where we are today, it was the 10-year and 3-month that has gone negative before the 10-year and 2-year. Now, this could very likely be explained by the amount of manipulation or intervention, whichever word you prefer, by the Federal Reserve trying to control interest rates, either through Federal Open Market Committee operations or through rhetoric, trying to guide or jawbone the market as to where they want interest rates to be. So I thought that was interesting because this is the first time in quite a while where you've had the 10-year and 3-month invert or go negative prior to the 10-year and 2-year. We'll see if that means anything or has any type of significance. But when we did our presentation highlighting the 10-year and 3-month alone, we noted that this was what the Federal Reserve happens to model. And they have a recession model that tracks the 10-year and 3-month. And that is now at a probability of a recession above 30%. I believe it's about 38%, if I'm not mistaken, by my last look at that probability model on the Federal Reserve's website for the Federal Reserve Bank of New York. Anytime, ladies and gentlemen, we have seen that prediction hit 30%, there has been a recession 100% of the time. So you can easily find that. That was on our previous presentation. You can find that on thecapitalnews.com, our website. You can find it on our YouTube channel at the Capital News. Or you can find it on the Federal Reserve's website for the Bank of New York. So check those things up. But I thought that was interesting to highlight here. And to date, the 10-year and 3-month continues to be inverted. Now, some other things I wanted to highlight here just to show the business cycle and the cyclicality of some of this data. So here we have the 10-year and 2-year yield curve against U3, which is the unemployment figure, the headline figure. And we've done presentations on this as well, and we talk about this at length during a whole host of our podcasts. And the U3 figure is the headline figure that gets put out there. And so this is right now at about 3.7%, just off a multi-decade low in the unemployment figure. But the reason I want to post both of these things against each other is because I want you to see the cyclicality. I want you to see the shape of these graphs and how they move in tandem with each other. This is the business cycle, folks. I know we live in a world that is highly contested with politics. It really doesn't make that much of a difference who's sitting at 1600 Pennsylvania Avenue, whether it's a Democrat or Republican, somebody you like, somebody you despise. The economy is bigger and greater than all of us, as it should be. Now, the individual who is the occupant of the White House, along with members of Congress, they can do things. They can enact policies that may hasten and bring about a recession, or they may do things that sort of kick the can down the road. But recessions have not been outlawed. They are actually a healthy part of the process of allowing bad debts and bad businesses to sort of go out of business or to liquidate or restructure. Now, of course, it can bring a lot of pain with it, but kicking the can further and further down the road, which we continue to do, is not a good solution. And so I just wanted to highlight the cyclicality of this, just to show the point that the business cycle is the business cycle. It doesn't matter who's in the Oval Office. And I just want everybody to sort of understand that. And the next graph is going to highlight the same thing, but I've just drawn some trend lines on that just to highlight the fact that whether you're talking about the yield curve or whether you're talking about the unemployment rate, I mean, just look at how nicely these things move in tandem. And who would think it, right? The yield curve and unemployment, who would even draw these types of conclusions unless you're actually taking the time to understand the business cycle and look at a whole host of data? And this is clearly what it is. This is the cyclicality. This is the nature of the business cycle. So understand it. This allows you to be prepared. This allows you to become a better investor, so you can prepare yourself for what might be a more volatile season, a more volatile year. Do you get more defensive? Do you get cyclical? Do you get the growth stocks, momentum? What do you do? If you understand the business cycle, you can better position yourself and stay diversified, as we like to say here at the Capital News. So continuing with some of our analysis that we have been conducting through previous presentations, we have a yield curve. Okay, this is the 10-year and 2-year. So we look at a handful of recessions. If we look at the recession back in 1990, 1991, we see that we have our first inversion took place in January of 1989. The official recession began in July of 1990. So a duration of 18 months given our first inversion. And as you can see here, this asterisk indicates that it is a sustained inversion as opposed to a non-sustained inversion. Now, in that same year of 1989, we have another inversion. This one took place in August of 1989, and clearly that was 11 months before the recession was formally announced. Okay? Moving on with the next recession, which took place in 2001, we have a non-sustained inversion in June of 1998. That gives us a lead time of 33 months, so quite the lead time there. Then we have a sustained inversion taking place in February of 2000, which leaves us with a lead time of 13 months to its onset. Continuing onward with the Great Recession, which lasted from December of 2007 to June of 2009, we saw our first yield inversion, which was also a non-sustained inversion, taking place in February of 2006, which gave us a lead time of 22 months before the recession started. We then had a sustained inversion on the 10-year and 2-year Treasury, and that one took place in June of 2006, and that was 18 months of a lead time before December of 2007. Now today, we have a yield curve that was inverted, and that took place in August of 2019, but this was a non-sustained inversion. So, consistent with the analysis that we have done, this is very simple, but nevertheless, just for the sake of consistency, we go back and we look, okay, if we're looking at non-sustained inversions, if we just take the average of the few numbers that we have, and of course this is not a big sample, so this is not highly significant here, but nevertheless this is what we're looking at. We're looking at history to be a guide here. So if we're looking at non-sustained inversions, we have a 26-month average. This is the lead time before we find ourselves in recession. If this is the case, we will enter recession in October of 2021. Now, if you're President Donald Trump, that's good news for you, because you probably don't want to be running your re-election campaign in the midst of a recession. So if President Donald Trump can dodge that and carry out until October of 2021, he may be okay. Of course, that's politics. That's a world away, a lifetime away, but given this yield curve inversion, 26 months, that would be news to the president. If we have a sustained inversion, this will give us a 15-month average. And if we're just looking at today, that would take us to November of 2020. That would take us right down to the wire of election time, because election day is in November of next year in 2020. So that's the consistency there. And like we highlighted during our previous presentation when we were talking about the 10-year Treasury against the 3-month bill, we said pay attention to these dates. Because not only did I find this to be an occurrence in the 10-year and 3-month, but it's also an occurrence here in the 10-year and 2-year. And it's also an occurrence in a whole host of other financial and economic data that I find when you're looking at dates. And it's quite miraculous. It's almost too coincidental to be coincidence, but it's something that I always highlight, because if you just look here, you have August in the recession, for the recession of 1990 to 1991. Okay, there was an inversion. Where are we today? August. Go back to the 2001 recession. You got June and you have February. Look at the Great Recession of 2007 through 2009. You have June and February. So it's quite interesting that the same months replay in replay. So this is something to be mindful of. And as we make our way through various other presentations to come, you're going to see that this takes place over and over and over again. So it's quite interesting. So with that, we're going to conclude this presentation. Thank you so much for joining us. Please like, share, subscribe, get the word out, and leave your comments. We do love hearing from you because the yield curve is something, especially if you pay attention to the financial markets, leaves a lot of people with some strong opinions. I believe in the credibility of the yield curve. I've done a lot of research on this. Even the Federal Reserve believes in it, although they are not going to come out and admit that there is a recession coming because they'll be blamed for it, and they don't want to take responsibility for it. But nevertheless, they have models that predict accurately recessions. And so we think that the yield curve carries a lot of water. And there are other treasuries of different durations that we are also going to be doing presentations on, like the 10-year against the federal funds rate. We're also going to be probably looking at the 30-year Treasury against the 5-year Treasury, and then a whole host of others as well. So stay tuned for a lot of those things. And please follow us on thecapitalnews.com. We post other articles and videos there and our daily podcast. You can also find us on the Capital News on YouTube and on Apple Podcasts, and you can follow us on Twitter as well. If you'd like to support us, you can also buy our book, The Cynic's Guide to Investing. In the era of too big to fail, it pays to be a cynic. And I thank those who have taken the time to purchase the book, and I look forward to hearing your comments on it, because this is a book that we published back in 2015, and we were describing the state of the economy, how the economy functions, providing investment strategies. And what we have found is that day after day, what we predicted, what we highlighted throughout the entirety of the Cynic's Guide to Investing, it has been coming true. Our predictions have been coming true. What we said, where we find ourselves today, we anticipated this, that diminishing marginal returns were going to kick in for monetary policy and fiscal policy, that the consumer, that the household, that governments, that businesses were going to be oversaturated with debt. And so we laid out a groundwork on how to stay diversified and how to invest in a prudent manner. So we hope you take the time to buy our book, The Cynic's Guide to Investing. We hope you enjoy it. So thank you again, ladies and gentlemen. As we like to say here, stay diversified, stay vigilant, and stay with the Capital News. Until next time, thank you so much. I am Alex Karitis.